In this video, I'm going to be guiding you through Chapter 32, Monetary Policy. The definition of monetary policy is adjusting the interest rates or the overall money supply to successfully control aggregate demand in the economy. It can strongly influence aggregate demand to actively help achieve its various macroeconomic objectives. As fiscal policy is a tool, monetary policy is their other tool. The government is able to utilize any of these tools to manipulate the aggregate demand in the economy. So, monetary policy is interest rates. Interest rates are the price that must be directly paid to lenders in exchange for the use of borrowed money, and this is expressed as a percentage. Very simply put, this is the cost of money. For example, if you borrowed $100 of your friend, and your friend was to charge you 100% interest, then you need to pay back the initial $100 borrowed, this is called the principal, and the interest on top, which is 100%, which is another $100. So your total repayments are $200. There is a misconception that the government sets the interest rate. This is incorrect. In fact, the central bank does. And the central bank is completely independent from the government. Some examples of some central banks is the European Central Bank, the Bank of England, the Federal Reserve, Bank of Japan, Reserve Bank of India, and many, many more. So how do interest rates affect customers and businesses? Low interest rates will affect customers in a positive way. As demand for loans increase and borrowing becomes much cheaper, consumers will be able to borrow more money to spend on goods and services. Furthermore, the incentive to save money is low. This is because the interest on savings are low. Therefore, the incentive to spend it is greater than the incentive to save it. And another point, that the repayments on current debt falls, meaning it is cheaper to service the debts that consumers already have. For example, if a consumer was in $1 million worth of debt with an interest rate of 10%, this means that this consumer will need to spend $100,000 in interest payments alone. But if the interest rate was to fall down to 2%, their interest payment on this same $1 million will fall from $100,000 to $20,000. This is an $80,000 saving for the same loan. So what do we do with all this spare money? Yep, we spend it. And the inverse to this is true. With higher interest rates, this will encourage consumers to save more money into their bank accounts as the interest on their savings are higher. So putting $1 million into your bank account for a year will yield you $100,000 if the interest rate was at 10%. So when you're saving more, you are not spending. On top of that, repayments on current debt increases. On the same $1 million loan, at 5%, that's $50,000 of interest payments, and at 10%, that's $100,000 of interest payments. And because you are paying more in interest, your disposable income decreases, therefore you will be buying less goods and services in the economy. Aggregate demand falls. And in the case for businesses, low interest rates will make the interest payments on current borrowings to fall. This will lower the costs and will boost the profits of the business. This will also raise business confidence and stimulate further investments as returns on their investment will be high. This will mean that the business will borrow even more money at a cheaper rate, expand their business, employ more people, produce even more goods and services, and become even more profitable. And in the case for high interests, businesses will reduce their borrowing because it becomes more expensive and less profitable. And these investments, such as business expansion, will decrease. The reason for downsizing is that they could have taken some loans at a very low interest rate. But when the interest rates increase, the cost to resurface this debt increases. And if the business cannot bear the burden of this debt, they will need to downsize. So quantitative easing is that when central banks use this tool to provide money to all stakeholders in the economy. And this involves buying financial assets like government bonds from commercial banks. You don't really need to know what a bond is, but it's just a fancy term for debt. For example, you wanted to borrow $1,000 from your whole class. You stand up in front of your class and you say, I need to borrow $1,000, and whoever is able to lend me $1,000, I will pay them 5% in interest every year. Someone is willing to take your offer and transfers you $1,000. Now you, upon receiving this $1,000, you write a certificate that says, this bond is valued at $1,000, and any holder of this certificate shall receive 5% every year for the next 30 years. And now you give this certificate to the person who was willing to lend you money, and it is legally binding. And that certificate was a representation of a bond. So the central bank will buy as many bonds that it needs from commercial banks. This will provide ample liquidity for the economy to get it kick-started again. Quantitative easing is usually used by governments during a deep recession. And due to quantitative easing, this allows businesses and consumers to make new loans, which will increase the aggregate demand of the economy. However, the problem is that too much quantitative easing is very inflationary, because essentially the central bank is buying all of the bonds that is required. And where does the central bank get its money from? It simply creates it. I hope that helped. I hope you guys have a good day. Bye-bye.